stock market is officially open for trade. We do see that equities remain lower, of course, as the conflict in the Middle East continues. Oil prices are rising. Joining me now with more is Patrick Mueller. He's president of Bella Advisors. Patrick, welcome. It's good to have you on the show this morning. What is your take on where we stand in equity markets right now?
Right now, with the equity markets, we are just really overvalued in tech right now. You had last year, the S&P 500, even though it finished up around 17%, you had 40% of the S&P that was a negative. And the top 10 companies equating for 40% of the growth of the S&P. So the S&P right now is really more like a tech fund. So I would just tell people to be cautious of that and make sure they're a little bit more diversified than being overweighted in tech right now.
We see Brent crude oil, ICE Brent crude oil, I should say, right below $100 a barrel at $99.95 as this equity market opens here today. What impact does that have?
It's going to have a huge impact on inflation in the future, because that's just going to raise the cost of everything when everything's being transported for goods and services around the world. We're going to start seeing inflation creeping back up again because of those higher prices, and it's definitely going to start hurting consumers' pockets because they won't have as much to spend if they're spending at the gas pump. So as we see things escalating and we see these crude oil prices coming up, I mean, hopefully that will be temporarily. But we're definitely going to be seeing some price inflation from that.
Yeah, we'll be watching that closely as well. Of course, we do get an inflation read tomorrow, the Personal Consumption Expenditures Index. It is the Fed's preferred inflation gauge before it meets next week on rates. However, this data we know will not include some of the rising oil prices that we've seen during this month of March. What do you anticipate from the Fed, and how does that report on Friday factor in?
Well, I think the Fed has been pretty cautious for the last year or so. They've been pretty adamant about when they were going to be cutting rates and sticking to that. And they said they could anticipate one more rate cut this year and they're going to be easing off. So I would expect that when they're going to do that, I would bet that it would probably closer to summer to later in the year before they start making any rate cuts. And I think they're just paying attention to, especially with what's happening in the Middle East right now and Venezuela and all these different things that we're getting into around the world, then it's going to be, if it were me, right, I would be cautious on making any rate moves.
Yeah. You know, it's interesting. Several economists pricing in about 2 rate cuts this year. Of course, we'll see how the scenario plays out. But the last time that we had seen gas prices rise like this was in that 2022 timeframe, and that did have an impact on equities. Do you think this time is different?
I don't know necessarily if it's going to have much to do with the rising oil prices right now, but I do think that we're overdue for a pullback. Everything is so overweighted towards tech right now, and I don't know what that catalyst is going to be, but we've seen the S&P and basically the markets trading sideways since around November. And we're waiting for a breakout now, whether we're going to break out of this and the markets keep propelling upwards out of that little price home right now, or is it going to start being pulled back? I think it's probably more towards being pulled back. So people should be taking a look at taking some of those chips off of the table, repositioning things that aren't going to be so affected by the overall markets right now, looking for yield right now more so than growth. So I would be really cautious right now of just having too much tied to that particular sector.
Yeah. Patrick, what else is on your radar as we do see this persistent choppiness in equities?
Yeah, the other things that are on the radar, longer term, you've got things reshoring, manufacturing back in the country. So longer term, I think that's a good move to place money. And also energy infrastructure. You've got all these AI centers that are opening up all over the country. We need all these data centers. We need the power. There's such a huge demand for that right now. So we're looking a lot into that longer term. And then for shorter term, we're looking for yield. There's great places like JEPI that are out there that, you know, we can get an 8% yield and not have to deal with the ups and downs of the markets here in the near future.
Yeah. You know, it is interesting. Earnings are certainly quiet right now, but how might higher oil prices impact corporate results when we see the next batch of those start to come out?
As far as corporate prices go, I don't think it's going to have too much of an effect by that. I think it's going to have more of a consumer effect and the consumer reaction to the gas prices at the pumps. So when it comes to the service industry right now, that's really where the sticky inflation has really been with wages. I think that's going to have more of a corporate effect as far as the prices on wages and making that inflation sticky from that standpoint.
All right. Patrick Mueller, president of Bella Advisors. Patrick, thanks so much for joining.
Thank you very much.